Hello friends, this is Dr. Amarjit Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. It's my privilege that I am with you this day to talk about traditional techniques of capital budgeting, and in this session we are going to talk about payback period method, which is a very important traditional technique, non-discounted technique of capital budgeting. So friends, what is capital budgeting is very well known to you, I believe. In the previous sessions, couple of 2-3 sessions, we have discussed about what is capital budgeting, the technique which is used to evaluate investment proposals, investment in building, investment in machinery, plant, modification of building plant, etc., etc. So whenever we intend to, as a business, we intend to invest into long term assets which are not meant for sale, which are going to be retained for over the couple of years, of course for more than 12 months, and which are going to help us generate profits, are the capital budgeting decisions. And certainly we evaluate every proposal we get with the help of certain techniques, and those techniques which are used for evaluating, they are divided into two parts: traditional techniques and the modern techniques. In traditional technique, which we discussed in the past, one technique is average rate of return or accounting rate of return. It has been discussed in a previous session, and today we are going to talk about another traditional technique, which is payback period method. So what is payback period? The name is very suggestive, right? So the payback period is the period which measures the number of years required for CFAT, cash flows after tax, to pay back the original outlay required in an investment proposal. Thus, this PB or the payback is the length of the time that it is going to take for any project to recover the initial cost out of its cash receipts that it generates. So, what does it mean? So, let us say I am going to invest 10 lakhs today, right, and it is when I calculated that how many returns I am going to get, I calculated first year it will give me 0, second year it will give me 2 lakhs, third year it will give me another 2 lakhs, fourth year it is going to give me 6 lakhs. So, how many years I took? First year 0, second year 2 lakhs, third year 2 lakhs, fourth year 6 lakhs. So, 2 plus 2 plus 6, 10 lakhs, right. So, it means after 4 years I am going to recover my investment of 10 lakhs in this example. So, this period, which is going to take to recover the initial investment or original outlay or outflow is known as payback period. So, important is I am not considering accounting profit as a recovery. I am considering cash flows after tax. So, it means the cash flows which are expected, we adjust them for depreciation, because depreciation is a tax deductible item. We subtract depreciation from the revenue net income after after subtracting all the incremental expenses. We subtract depreciation, whatever is left we subtract tax out of it, and then whatever we get we add back the depreciation, because depreciation is a non-cash item but is a tax deductible item. So, since it gives us the benefit of reducing the tax, and on the other hand it is a non-cash item, so we once subtract it, calculate the exact amount of tax, and then we add back. So, that is how we convert cash flows before tax to cash flows after tax, and that is what we consider. So, we are going to make a total of the cash flows which we are going to earn in future, and we are going to see how many years it will take to recover that. So, PB is the length of the time. So, the answer is going to get into years. It could be absolute year, it could be in decimals. So, irrespective, that is how we do that. Now this payback period technique, the original investment or outlay is relevant cash outflow for the purpose of project at the time 0. I may invest in future as well, right. So, I have to take the total outlay, and when the net annual cash inflow is same each year, we can use the following formula which I am going to show you soon. Then it is easy. So, inflows could be in two forms, one in annuity form, right. So, they are same every year. So, the example I just quoted, first year 0, second year 2 lakhs, third year 2 lakhs, fourth year 6 lakhs, and so on. In future I may have some other amount. So, this is uneven cash flow, that example I took. But if I say the 2.5 lakhs first year, 2.5 lakhs second year, 2.5 lakh third year, fourth year, fifth year, sixth year, seventh year, it means 2.5 lakhs every year, and the life is 6 years for all the 6 years. So, how many years I will take to recover 10 lakhs if the investment is 10 lakhs? 4 years again. But here the cash inflows, the example I took, they are in the form of annuity, this smooth. In the previous example, there was up down, right, uneven cash flow. So, the point I am making is this, the cash flows could be uneven or they could be in the form of an annuity, right. So, annuity means they are consistent every year. So, if they are, so I am not discussing the first situation where cash flows are happening each year of the same amount, means they are happening, they are occurring in the form of an annuity. So, what formula do we use in that situation? So, the payback period can be calculated by dividing investment required with net annual cash inflows. So, the payback period is the number of years, of course. The total investment which is required is divided by the net annual cash inflows. So, I am going to take up one example to help you understand this particular technique under an annuity inflow format. So, the management at ABC Limited wants to install an espresso bar in its restaurant. The espresso bar is going to cost 140,000 and has a 10 years of life. So, will generate net annual cash inflows of 35,000. So, what would be the number of years n in terms of payback period? Very simple. How much are we earning every year? So, the cash flows which are given annually, right. So, every year it will generate net annual cash inflows after tax of 35,000. So, which means if I divide, so the management requires what? The further information is the management requires a payback period of 5 years for sure or less than that. So, what would be the payback period for this company? We divide 140,000 with the average annual cash inflows of 35,000, answer would be 4 years. So, the project is acceptable. Why? Because company has set a standard of 5 years. What is 5 years in the given situation? The 5 year is the expected recovery time. So, how is it decided? So, let me just discuss this. Every company has a cost of funds, right? Every company has different sources of fund, and every source has a different cost. Equity is the most expensive source of fund, debentures are generally the cheapest source, right? So, company knows exactly how many years the fund is available to them, and in past, basis on the past experience, they see they have been able to recover the investment in X number of years. It could be 4, 5, 10, 12, and also depending on the project. It could be compared with industry averages as well, right. For example, an Hydra plant will take longer duration to recover the initial investment than simply setting up an espresso bar at the coffee. If if the restaurant is already running well, adding up a new machine to sell more coffee would not take much longer. But if it is a hydro plant, solar plant, the power plant to be set, those long term projects, then certainly the the number of years it is going to take to pay you back the full money is going to be more, and company has to put up a realistic standard. So in this caselet, what was 5 year? 5 year was a standard fixed by the company's management, right? No one else is going to decide. Company's management, accountant, CFO, they would see what is the average return period in these type of investment for other companies, what has been their average return in the past, and basis on these numbers and experience, they will decide the number of years for them to recover the initial investment. So 5 year becomes the standard in this case, and my actual calculation of payback is 4 years, right? So what would be the answer? Answer is that it is recommended to accept the proposal because my actual payback period is 4 years, whereas my standard payback, expected payback period was 5 years. Since the actual is less than the standard, so the answer is I should recommend that company should accept the proposal. So that's how we evaluate any proposal using payback period technique, right? So now let me take another example. If an investment of 80,000 in a machine is expected to produce CF80 of rupees 10,000 for 10 years, what would be the PB? So what is happening? The expected investment is 80,000, expected cash flows after taxes are 10,000 and they are for 10 years. So if I divide 80,000 the initial investment with my annual inflow 10,000, that which is cash flows after tax, my N is 8. So company need to compare it with the standard they have. Standard is not given in this situation, but my PB calculation is 8 years. My answer becomes 8 years, right? Now this was the first situation where we have the inflows in the form of annuity. They are smooth every year, the same value. What would happen if my cash flows are uneven or mixed stream? So in such situation, PB is calculated by the process of cumulating cash flows till the time when cumulative cash flows become equal to the original investment outlay, right? So by cumulating, so cumulating is the key here. So let me take this example to help you understand. So the calculation of PB in mixed stream, year 1, 2, 3, 4, cash flows are given which are after tax, 12,000, 4,000, 8,000, 16,000, right. Initial investment at the top is given 20,000. So what would be my cumulative cash flows? 12,000 in the first year, second year would be 12 plus 4, 16,000, third year would be 16 plus 8, 24,000, and fourth year would be 24 plus 16, 40,000. So total cumulative cash flows over 4 years are 40,000. How much I am expecting to recover? 20,000, right? But so what would be the answer in this situation? So in these situations, when we are not recovering the full amount, absolute amount in absolute year, what do? We take the amount which we are closest to the initial investment. So 20,000 is closest, right, to 16,000. So 2 years after that I have to recover 4 more thousand, right. So the 4 more thousand will be recovered in third year. So it means my answer is 2 years plus few months, some part of the third year as well. So how do we calculate the part of the third year or the next year is important, because people commit mistake here. So I have recovered 16,000 after 2 years, and remaining left amount or remaining amount is 4,000 to be recovered in third year, and my total inflow in the third year is 8,000. It means 4,000 divided by 8,000, so 0.5, right, becomes my decimal to be added in 2 years. So 2.5 years would be my answer. So why I am saying the people commit mistake here? Because most of the people will take the remainder 4,000 which is to be recovered, they will divide it by the total cumulative amount of the third year. In this case it is 24,000, which is a mistake, right? I have seen students committing this mistake very often, and during my classes I also really warn my students, I really caution them, please be careful about this, that we do not divide. The denominator would be the cash flows of the next year, not the cumulative cash flows, right? So 4,000 to be divided by 8,000, not by 24,000. So be careful about that. So in this case, the answer becomes 2.5 years. So this is the calculation of PB, payback period, when the inflow is in mixed form or uneven form. I hope you are able to follow up what I am saying. So what would be the accept reject criteria in payback method? So the payback period can be used as a decision criteria to accept or reject investment proposal. One application of this technique is to compare the actual payback with the predetermined payback, right? So we got 2.5 year as an actual, in this example. So if the company has more standard years, let us say 5 years, 6 years, 4 years even, this particular proposal would have been accepted. So the standard or the accept reject criteria is comparing the actual PB, the payback period, with the standard which is fixed by the management, and that becomes accept reject criteria. In accounting rate of return, again the cost of the capital is generally taken, or average weighted rate of or average weighted cost of capital is taken as the standard. So every technique in capital budgeting has some accept reject criteria, and here it is comparing the number of years fixed as standard with the actual, and we get to know either to accept or to reject the proposal, right. So after discussing or taking these two examples and taking these two situations, now the time comes where I critically review the payback method, means I discuss merits and demerits of payback period. So what are the merits of payback period? The first merit is it is easy to calculate. The second is simple to understand. The third is it considers cash flows after tax, and the fourth is a screening tool. So let me discuss these merits in detail. So when I say easy to calculate means what? We are taking cash flows and we are comparing it, we are deciding simply the basis on the standards of the N or years we have kept as acceptable period of payback with the actual payback period. So we simply are dividing the investment with the average investment, or in case it is uneven, then we are cumulating. Cumulating is just the plus, addition in of the new year's value with the previous year value. So it's not really difficult to calculate, and most of the time PB is used along with IRR or along with NPV. So PB is the most commonly combination technique, right? It is used in combination with other discounting techniques. So, so since it is easy to calculate, so it's easy to understand as well. Lalaji, we say Lalaji in the business. Lalaji understands कि मेरे इस investment को recover होने में इतने years लगेंगे. That's how they take it. So Lalaji understands that how many years will the investment take to fetch back the full investment made in any project. So it's very easy to calculate, easy to understand for Lalaji. That is fine, I can accept, मेरी recovery 5 years में हो जाएगी, मेरी recovery 4 years में हो जाएगी, 10 years में हो जाएगी. And if they know the life of the project or the machinery or the equipment is 10 years, 20 years and recovery is in 4 years, what does it mean? It means investment is recovered in 4 years and the machine is going to work for me or generate profits for 20 years, then I would be very quickly able to comprehend the situation. Wow, that after 4 years I have no investment actually left to be recovered. Whatever I am earning is absolute profits for me, right? So my investment is recovered so early, so quickly, and it has such a long life. For example, the car, you know, the generally the if let's say if you buy a car for 10 lakhs rupees and you are using car for cab services, and you know that you can run the cab for these many hours a day, and you can charge 15-20 rupees per kilometer, and you can actually earn about, you know, 2 lakhs per month, and your investment is 10 lakhs. So how many years on an average you will take? About 5 years to recover the total 10 lakhs investment, whereas the life of the car in NCR and most of the cities in the country is 15 years, right? For petrol car or for an EV vehicle. For diesel it is of course 10 years. So if I know as a Lalaji, as an investor, that my investment is X amount which I will be recovering in these many years, and the life of the project is so long, or the investment is, or the of the asset is longer, much longer than the recovery period, I would understand it like anything. I would quickly decide to invest. So that's how we say it's easy to calculate as well as easy to understand. And the important thing is, unlike the accounting rate of return, where we were using only the accounting profits. Here we are not using accounting profit. This is a traditional technique because we do not discount cash flows, right? But nevertheless, instead of using accounting profits, we are calculating payback period by using cash flows after tax, CFATs, which is relatively better for sure. You know, relatively means if using accounting profits versus using cash flows, because my outlay or outflow is in the form of cash. My inflows should be compared, you know, which are comparable to the outflow. And so since my outflow is in cash, my inflow should also be in cash only. So here in this formula, which is though a non-discounting technique, we are still using cash flows after tax. And the last deal, it works as a screening tool, because this is one of the requirement. You know, you may have net present value, very huge amount, but if it's taking longer period than the required PB, it is of no use. So this particular method of PB is used as a screening tool before we apply IRR or net present value, which are the discounting techniques. So these are the merits of payback period. Now comes the demerits of the payback period. I am going to discuss 4 of them here. Number 1, it ignores cash flows after payback period. Number 2, it ignores time value of money. Number 3, it does not consider entire life of the project. Number 4, the difficult to calculate in case of uneven flows. So let me just discuss these 4 points now. So it ignores cash flows after PB. Let's say I invested 10 lakhs rupees, right, and my initial investment is 10 lakh, and I am able to recover, let's say 10 lakhs in 4 years, 2.5 lakhs every year. But after 4 years, I am actually earning about 40 more lakhs in the future years. And project B, there is another project which is actually recovering my initial investment, let's say in 3 years. But after the recovery of initial investment, it gives me only 8 lakhs. So, but if I apply only PB between A and B, the 2 projects, I will select project B, right, because A is going to give you longer PB of 4 years, and B project is giving you PB period of 3 years. Whereas the project A was giving you after the PB about 10 lakhs, 20 lakhs, 30 lakhs, whereas a huge amount, whereas the B is giving you only 8 lakhs, right. But logically, if I apply only this particular method, if I don't use my brain, I will simply say, basis on the PB, I will recommend project B, which is a wrong decision. This is a very important aspect of demerits of PB period. Before you actually reject or accept a project based on PB, please do consider the cash flows expected after the PB. That could be huge amount which you simply may ignore because of your limited understanding of PB method. The second is that we do not consider time value of money in this PB method. As we did not consider time value money in accounting rate of return, the first discounting technique, and PB being the second discounting technique we are discussing, here also we do not consider time value of money, which means we do not consider the discounted value of future inflows. We take them as it is, whereas the fact of the matter is the money which is received in future has not the same value, right. So, this is the important limitation, another important limitation of this method. Third, as I said, it does not consider the entire life of the project, because we just consider what are we receiving today. We do not consider what we will receive after the PB, right. The PB method is actually something which is used in combination, then it becomes effective. But if we use it only as one method in isolation, then I am sorry to say the decisions taken by you would not be that reliable or would be worth of actually maximizing your shareholders' wealth. It may in fact result into something wrong. So, which means your decision may turn as a bad decision. The last point is it difficult to calculate in case of uneven flows. So, as we just noticed in the past, if it is an even cash flow is very quick. We simply divide the investment with the average inflows and we get the answer in years. But if it is uneven, then we have to make a cumulative cash flow. Even that is not too much difficult, of course, but still it is little more than the average. So, these are the limitations of PB or payback period. I hope friends you were able to understand this PB period method or payback period method of capital budgeting, which is a non-discounting technique or a traditional technique. And as I said, it is an important method because it gives an initial idea, because it does not take long for anyone to calculate. It gives an additional idea to further evaluate the project by using any discounting technique, be it net present value or be it internal rate of return. So, with this I would like to wind up, time to sign off. Goodbye for now. Thank you.